The stock market is often a sentiment indicator and can impact the GDP or gross domestic product. GDP measures the output of all goods and services in the economy. As the stock market rises and falls, it can have both negative and positive effects on GDP. Warren Buffett says that all there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. Now it's time to really put those words into action. Hi there, welcome to Investors Game. Today we're gonna talk about, is it too late to invest in the stock market? And give us a thumbs up, that helps us a lot, so let's get started. How does the stock market affect GDP? The stock market is often a sentiment indicator that can impact gross domestic product, either negative or positive side. In a bull market, stock prices are rising, consumers and companies have more wealth and confidence, leading to more spending and higher GDP. In a bear market, stock prices are falling, consumers and companies have less wealth and optimism, leading to a less spending and lower GDP. Understanding how the stock market affects GDP. Before we can determine how the stock market impacts GDP, we must first review what drives growth in economy. The US economy GDP is primarily driven by the spending and investment. GDP is typically shown as a percentage growth rate from one period to another. For example, the quarter-to-quarter growth rate might be 2%, meaning the US economy grew by 2% in the quarter on an annualized basis. And what's the GDP percentage of the United States? Well, as you can see in the chart, there is no good news for the US economy, because in the second quarter, US dropped more its GDP to 32% less than other quarters. Here are a few of the key components that make up GDP. Consumer spending, which is the primary driver for the GDP in the US. Businesses spending, which includes purchases of new plant and equipment, hiring people, investing in new technologies, and building new offices and factories. Exports, which are sales from domestic companies to customers internationally. Government spending, which includes building roads, bridges, and subsidies for industries, such as agriculture. All of the above components that make up GDP can also be influenced by investors either negatively or positively through the stock market. The stock market's impact on GDP is less discussed than the effect of GDP on the stock market. When GDP rises, the inverse occurs when GDP falls, leading to less spending by businesses and consumers, which drives the markets lower. However, whether it's a bull market or bear. Now, how does the unemployment rate affect the stock market? Consider this simplified example. Let's say that you run a restaurant and had 30 employees before you were forced to close your dining room. You retain 5 of them to provide takeout services and laid off the rest. Once you're allowed to reopen your dining room, your state governor limits indoor dining to 25% of capacity in order to maintain the social distancing. Are you going to hire back all 25 employees that you were forced to lay off? Probably not, at least not right away. Along with experienced investors, they determine that the market will crash soon. Could happen for the US elections or sooner as well. One key that investors need to keep in mind is that these are just projections. Although we've learned more about the novel coronavirus than we knew a few months ago, there's a lot of things that we don't know. Nobody can tell us for sure when the pandemic will end, whether a second or a third wave of infection will come, or what each individual state will do with the terminal of reopening their economies. Because the economy declined doesn't mean that the financial market would collapse. However, there is a strong connection between both. Because finance works separately from the economy, traders can continue trading activities despite current problems concerning any specific economy. Small businesses vary greatly in terms of the types of products and services they provide, but all companies need to make sales and bring in revenue to survive. When companies are not profitable for extended periods, owners may force to go into bankruptcy to exit their market or reorganize their business. While the lack of profitability is the primary reason for most bankruptcies, many underlying factors can prevent a company's ability to make profit and lead to bankruptcy. We also have to understand that if a business got bankrupt, this could lead the market to a different direction. Here are some causes of a business bankruptcy. Market condition. Poor condition in overall economy and a specific market in which a business operates are common causes of bankruptcy. The economy tends to follow a boom and bust cycle of rapid expansion followed by recession. During bust periods, consumer confidence and spending tend to decline, which can lead to low revenue. Companies involved in specific niche markets can also be susceptible to shifts in consumer preferences. For example, a small business owner that owns a music store might be forced to close shop if customers start buying digital downloads instead of CDs. Competition from a larger company is another market factor that can cut into revenue of small companies and lead to bankruptcy. Number 2, financing. Financing is one of the primary challenges that small businesses face. Many business owners take out loans to help finance their operations. If a business struggles, his lender may not be willing to grant additional funding, which could lead to bankruptcy. Even if an owner can secure more financing to keep his company afloat in the short term, high debt makes it more difficult for a company to be profitable because it has to pay interest on the debt poured. Number 3, decision making. Lack of planning and level-headed thinking can lead to hasty decisions and business failure. For example, a business owner may spend time and money developing a product that she believes in without surviving customers and starting production cause to gauge whether the production could be profitable. Even if a production is useful, it might not be financially viable from a business standpoint. Lack of education and experience in finance and management can increase the likelihood of poor decisions, but no company is immune to making mistakes. But before we move on, let's recap what you learned in this chapter. First, the stock market is often a sentiment indicator and can impact GDP, and it measures the output of all goods and services in the economy. Second, Warren Buffett says that all there's to invest in is picking up good stocks at good times and staying with them as long as they remain good companies. Third, the US economy GDP is primarily driven by spending and investment. Fourth, when companies are not profitable for extended periods, owners may be forced to go into bankruptcy to exit the market or reorganize their businesses. Fifth, lack of planning and level-headed thinking can lead to hasty decision and businesses failure. If you like this video, don't forget to hit the like button. Let me know in the comment box, would you invest right now or would you wait for a better opportunity? Subscribe to my channel because every week I am in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.